The war in Ukraine has caused immeasurable human suffering. It has also created all sorts of economic shockwaves, and the global financial system is not immune to them. Let's take a closer look at why. The war came at a time when the world was recovering from the pandemic, adding to inflation and supply chain issues, and weakening the economic outlook. Russia and Ukraine are both major commodity producers. Between the war and sanctions on Russia, commodity prices have surged. And these rising prices are further fueling already high inflation. That puts central banks in a difficult position. They need to contain inflation without causing a recession. Central banks have already taken decisive actions and raised interest rates. And more hikes are expected in the coming months to bring inflation down to target. So what has this all meant for global markets? Global stock markets saw sharp declines in February and early March, adding to the drops earlier this year as investor appetite for risk assets has declined. Russian stocks had lost over 40% from early February and early March because of fears about the war. Even after a partial recent recovery, they're still down over 20%. Global equity markets had dropped up to 10% at their worst point. However, they have recovered recently as business fundamentals remain strong in many parts of the world and hopes for peace persist. In advanced Europe, the stock markets initially saw deeper declines but have recovered recently. More globally, emerging markets are in a difficult situation, facing higher financing costs and greater risk of investors moving capital out. Many emerging market countries with low credit ratings have delayed new borrowing. Firms, especially small businesses, are struggling with supply shortages, higher energy prices, and rising labor costs. Without direct and targeted government support, firms could face bankruptcies and credit losses at banks would follow. When it comes to the banking sector, the impact of the war remains manageable. Except for some European institutions, most banks and funds do not have large investments in Russia, at least relative to their overall size. However, given how interconnected the financial system has become, they might be impacted in indirect ways. For example, commodity traders that have borrowed a lot from banks could face large potential losses from rapidly moving commodity prices. And there is still a risk of a big market sell-off if the war were to escalate. Overall, the global financial system has so far been able to withstand the impact of the war, in part thanks to stronger bank regulation and buffers built up after the global financial crisis.